When we invest, our emotions can often get in the way. This is something that we should keep in mind when we see the market go down. In 2023, the market started off strong. But then August and September came and turned things in the other direction. In fact, the S&P 500 fell by 3.6% in the third quarter, and October started off even worse. We're down 4% year to date. We never know for sure what's causing the market to fall, but most would attribute it to the wars that we have ongoing in Ukraine and the Middle East, and the rising interest rate environment. There's also concerns about the economy. We have war in the Middle East can also lead to higher oil prices. It's important to keep our emotions in check. Pictured here, you also see the cycle of market emotions. That talks about how, as the market starts to go up, we start out optimistic, we get excited, we get thrilled. When the market is at its peak, we think about how smart we are as investors, we get kind of euphoric. Then the market starts to turn and we get anxious. We deny that it's happening, we get fear, we feel fear, we have desperation and panic. Then we capitulate and we sell. When we're most despondent, most worried, we sell out of fear. And that's the point of maximum financial opportunity. Then the cycle starts to go back up the other way, and we start to get our optimism back. But this timing can really hurt. It's important to try to keep our emotions in check. Let's go to an example of what can happen. When we were in 1999, and the market was up, coming off a really strong year going into 2000, the NASDAQ was up 80%. That was tech stocks, that was the dot-com boom, and the market really soared. It was up, like I said, 80%. In January of 2000, investors added close to $44 billion in stock mutual funds, according to the Investment Company Institute. The previous record was $28.5 billion. February and March shattered even more records. The market lost half of its value by October 2002. At the low, what did investors do? They sold stocks. They bought bond funds, which were near record highs. At tops, we can't buy enough. Our emotions come in. We get greedy. At bottoms, the opposite happens. We can't sell fast enough. And this happens again and again. That's what we see on this graph that we have here, the cycle of market emotions. Think about it. Would you let your emotions do this to you in other settings? Would you go into your car dealership to buy a new car? And when the salesperson says to you, "You're in luck, we just raised the price," would you respond by saying, "That's great, I'll take two"? That's kind of what we do with the stock market, but we wouldn't do that with a car. It's okay to feel scared when the market falls, but you want to be careful about acting on it. That can cause financial harm. You want to try doing whatever you can to avoid acting out of fear and greed. You want to try to help keep your emotions at bay. That could mean not watching as much financial TV, because when the markets fall and people are scared, what happens? They get louder. Why? Because that makes people watch and pay attention. You want to try to remain calm. Remind yourself that you're investing for the long term. Remind yourself that the most important thing isn't to build the biggest portfolio. It's to be able to live your desired lifestyle now and in the future. It's to live your most fulfilled life. So try and keep your emotions at bay. Try to remain calm. If you have questions or you'd like to talk about this, please feel free to schedule a call. Thanks for listening and have a great day.